Hey guys, Mike from Mortgage Nerds here in Appleton. I am with
Pam from Mortgage Nerds here in Appleton.
Yes, you are. Today we want to talk to you guys about terms. So 30-year, 20-year, 15-year term. A lot of times you guys will call in and say, I'm looking for this type of loan. So more often than not, a 15-year
Right.
if you want to pay off your mortgage sooner, that kind of stuff. We're going to go a little bit deeper into that today rather than just getting a 15-year. So Pam's got a little situation or a scenario, let's say, to start with, and we'll kind of go off of that.
Exactly. So I had a client recently who has about 20 years left on their mortgage, has a first and a second. So we looked at numbers, crunched numbers, showed them the difference between a 15-year and a 30-year payment. Obviously, 15 years, they pay it off faster, but we talked a little further. They have about 15 years until retirement. So we talked to a financial person. He put some numbers together. The difference in the payment was about $450 a month between the 15 and the 30 year.
So 400?
$450 a month.
$450?
Correct.
Okay, so $450 a month. So if you did a 30-year, it's $450 cheaper
Correct.
than the 15-year.
Correct.
Got it?
So what we opted for was to take the 30-year loan and to be disciplined and put that extra $450 a month into an investment. And looking at the numbers, so in 15 years, what their loan amount was, they would have a lump sum amount, but in 15 years, that investment would be worth $81,000 more than what they could. So they could pay their mortgage off
in full
in 15 years, like they wanted to plan, and then they still had $81,000 left over after that.
And this is not uncommon. This is the power of compounded interest.
Correct.
And we didn't have the numbers, but obviously that $80,000 was because it went to the term of the 15 years.
Right.
It would have paid off sooner than the 15-year, right?
Right.
I don't know what that number is, but we can run that number specifically for you based on
Exactly.
your scenario. But we work with a financial advisor on a lot of scenarios, right? So we look at ourselves as mortgage advisors. And what that means is we look at your entire financial picture, how long you're gonna be at the home, what's your long-term financial goals, all that kind of stuff. But when you say you wanna pay or do a 15-year mortgage, we have to stop and have a conversation about, none of us care if you pay off your home in 15 years or less. I just think for 95% of the people out there, 15-year mortgage is not a good mortgage for you. It's not the best. Doing a 30-year, taking the difference, and even in some cases a lump sum from a cash out or whatever, and invest in that, you'll always pay off your mortgage sooner, put you in a better financial situation. Because a part of investing is leveraging risk. Right? So let's say 5 years into your scenario, let's say you're in a 15-year mortgage and 5 years into it, you get in a car accident, you can't work. You're off for several months and you're like, you don't have a lot of liquid reserves and you need to tap into that. Well, if you want to refinance your home, you gotta be working.
Exactly.
So you can't work, you're not working, you can't tap into the equity in your home because you already put all that extra money into the home. Then what do?
Yeah.
You have to sell the house.
Sell the house or,
You have to sell the house or borrow money from family or something like that. But in this situation, you technically have to sell the house in order to get any money out of it to get you to a situation where you were better. Or in this other scenario, it's an investment. It's semi-liquid. You can tap into that, borrow against it, that kind of stuff, working or not, doesn't matter. It's your money.
Right.
So leveraging risk and the power of compounded interest, paying it off sooner than 15 years. And how they run those numbers, by the way, I would have my financial advisor here, but they're under heavy regulation on what they can and cannot do. But what they do is they just go backwards. So they take history, and because nobody can see the future, what 8%, 10%, who knows what you'd make on your money, but they take the money from today's date and go backwards 15 years. And that's how they figure out
what the average you'll earn on your money.
Yep.
And if you're getting a mortgage for under 3%, it's cheap. You can
extremely
earn a
cheap.
lot more on a monthly compounded investment. than
Compounded
3%.
interest over time
Right.
is extremely powerful. And if you want to know what that data looks like, give us a call. We'll actually run the numbers on your specific situation. We could do a 30-year, have your mortgage paid off in 15.
Right.
We could do many different variables, but lots and lots of cool information there to pay off your mortgage sooner without doing a shorter term.
Right, and having a large amount of money at the end.
Absolutely. It's a beautiful, beautiful thing. So what this talks about and what we believe in is using your mortgage as a tool to build wealth. It's the best tool you guys have. And if you want to know more about it, give us a call. Now remember, mortgages are complex. Let mortgage nerds
Give you the answers you need.